Welcome to the Market Mosaic, where every week we are breaking down the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be heading over the near term. So for this week, we finally have an end to the longest U.S. government shutdown in history, but now investors have to contend with another challenge to the outlook for the bull market. So while President Trump signed a funding bill that ended the government shutdown at 43 days, you're now seeing several officials from the Federal Reserve pushing back on expectations for another rate cut at the central bank's final rate setting meeting coming up in December. That includes several prominent Fed presidents. So Boston Fed President Susan Collins pointed out that inflation levels remain elevated and that the economy is showing resilience, and that is a reason to keep rates steady. That echoes comments made by other Fed presidents and reinforces what we've seen recently is that the Fed has become deeply divided over whether they should be fighting inflation or doing more to support the labor market. So recent and what I would say available meaning the lack of reports because the government's been shut down, but the available economic data is showing that the economy is not deteriorating as many had feared, but you still have consumer inflation holding around the 3% level for over a year. That's well above the Fed's 2% inflation target. So because of this, because of the Fed talk, market-based expectations for a third consecutive rate cut in December has dropped to 44% after being as high as 94% just a month ago. So again, this is the odds that the Fed funds rate would fall to a range of 3.5 to 3.75%. That would represent another quarter point rate cut at the December meeting, and those odds for the Fed funds rate to end at that level have been falling sharply as, again, several Fed officials are pushing back on rate cuts. Now, stock prices could be particularly sensitive to any signs that the interest rate tailwind could be in jeopardy. That's because valuation multiples are elevated, and we'll look at that in just a second. Valuations have only been rivaled during the 1990s internet bubble, and because of what you're seeing with expectations on rate cuts, this pivot toward fewer potential rate cuts, you're seeing some of the speculative air coming out of high growth stocks and other pockets that tend to do well when the Fed's cutting rates. So we had the Fed cutting rates back in September, but now that there's this speculation that they're going to be more on hold, you're seeing groups like quantum computing stocks pull in. Well, you're seeing a lot of weakness in cryptocurrencies as well, and Bitcoin in particular is losing some key levels. So what's really interesting is that Bitcoin, even though you've had the S&P 500 recently rallying to new highs, and NASDAQ over the summer and into the fall rallying to new highs, Bitcoin has not been able to keep pace. You can see Bitcoin did try to pop above the $120,000 level back in October, but it was a false breakout, and prices quickly come back in and it's taking out some key levels. So while we've had this historic stretch of the S&P 500, not historic, but an extended stretch of the S&P 500 trading above its 50-day moving average, Bitcoin lost its 50-day, this black line, back in October, and more recent weakness is taking out some more levels. It's taking out the 200-day moving average, that's the green line, and closely watched price support at this $100,000 level. And so, again, the more speculative areas of the market that you would expect to be more sensitive to the outlook for interest rates are showing a lot more weakness here. And so this week what I want to do is look at how this outlook for rate cuts is shifting, but why we also have some more warnings on the inflation outlook and why the combination of those two things can leave growth stocks exposed to a pullback. But then also one thing we continue to see is investor sentiment is so quick to shift back toward bearishness, and why those attitudes toward the rally does remain a tailwind for the stock market. All right, so one key factor behind Fed officials voicing concerns over further rate cuts has been the resiliency in economic data. Private sector reports that we're getting during the government shutdown on manufacturing and service sector activity, those have been pointing to accelerating economic data. We've seen leading components shaping up favorably as well. But then also fears over the deterioration in the labor market haven't quite materialized as was once feared. At the same time, you could even argue that leading indicators of labor market activity are starting to improve. That includes temporary workers. That tends to inflect higher before a broader improvement in labor market data. And so that's what this chart on here is showing. It's showing the temporary help services and the year-over-year change in that level. And so that's why I want to track the year-over-year change in that level. So it's been turning up from a negative level, still in negative territory, but what tends to matter most for the stock market for forward returns is the rate of change in these indicators. So that the fact that we're turning up from a low level could be a positive thing for the stock market, but also reflects if we start to see this push into the rate of change push into positive territory, and that could be a good sign, positive sign for the labor market down the road. Stock market valuations are nearing some of the most extreme levels in history, just as this interest rate tailwind is getting called into question. So why are falling rates so important to stock valuations? Well, falling interest rates boost stock valuations through two main catalysts. So first, falling rates make the present value of future corporate profits worth more. So this whole, what companies are expected to earn in the future, you discount that back to the present to figure out the present value of those earnings. While you have to apply some assumptions to those earnings, and one of them, one key assumption is the interest rate that you discount those back at. And as the interest rate falls, the present value of those earnings grows. So that's why that is a valuation boost, why falling rates are a valuation boost. Well, falling rates also presents less competition for investor capital from fixed income securities. So when you have a high level of interest rates on a relatively safe, especially short duration fixed income security, that starts to look attractive compared to what you might expect out of the stock market. So when the outlook for rate cuts gets called into question, that can leave stock prices vulnerable, especially when you have extended valuations. And so that's what this chart on here is showing is the S&P 500's forward PE ratio. So using earnings expected over the next 12 months, and you can see as of October 31st, this stood at 22.9 times, all right? So 22.9 times, that compares to a 30-year average of 17.1 times. So S&P forward PE, well above the historical average. And you can see that right now we've moved above the peak seen in late 2021, which, heading into 2022's bear market. The only time that valuations have been higher was during the internet bubble in the early 2000s, late 1990s. So stock market valuations are collectively elevated while certain sectors are more exposed to the risk of this shifting rate outlook. So if you're not expecting as many rate cuts in the future, if that outlook starts to shift toward rate hikes, shares that could be very exposed include stocks showing strong return momentum and high volatility. Things in the more speculative corners of the stock market, quantum computing comes to mind recently. And so we can track those types of names. This chart shows a basket, a daily return, the basket of domestic high beta, so high volatility momentum stocks, which those names were doing really well as the Fed started resuming rate cuts back in September. We had a couple consecutive rate cuts, but now as the questions grow around the outlook for further cuts, these high beta stocks are seeing a quick momentum unwind. You can see last week, again, on this daily return, that this basket had one of its worst daily declines of the past 5 years here looking back. While valuations may present a risk to the rally, but there's one thing that we're not seeing, and that is widespread bullish investor sentiment. That's where you tend to see major tops as well, is when you get the valuations extended, but that sentiment is just way too bullish, and we don't have that condition right now. If anything, it appears that this bull market remains quite hated because sentiment is quick to shift back toward bearish views, even as we have the S&P 500 holding near record highs. So retail investor sentiment, you can measure that with the AII survey. Last week, it showed bearish views running at 49.1%. That easily outnumbered bullish views at 31.6%. Now, what this chart on here shows is you've only had this happened one time in history where you've had bearish views running that high when the S&P is within 1% of an all-time high. Again, that has happened only one time in history, back here in 2013. And the table down here plots what happened to the S&P 500 for several forward time periods after seeing that. And you can see, 6 months out, a year out, you had some really strong returns following that. Now, you take it with a grain of salt because this is a very limited sample size of just one instance in history. But again, just goes to show how quick investor sentiment has been to shift back into fear territory, which is not something you see if we were at a peak in the market. While Fed officials are voicing concerns over elevated levels of inflation, it could get worse. It could get worse because market sectors with high inflation beta, so sectors that tend to do well when inflation is rising, they are warning of rising price levels ahead because of the breakouts that we've been seeing. So gold prices broke out to record highs at the start of 2024. Gold miners eventually following suit, especially this year with a strong gain. We've seen that with copper miners as well. So copper miners recently rallying, breaking out. We've seen the LME global copper benchmark close to breaking out to new highs as well. On the next sector to watch is with energy stocks. So this is the S&P 500 energy sector. And this is important because energy stocks also have a high inflation beta. They also tend to be among the late cycle type of names that are moving as well. So watch out for this breakout in energy stocks. If you see a move out of this multi-year basing period, that would be another big warning on the inflation outlook as we head into 2026. All right, so we've gotten the bulk of earnings season out of the way. We still have a lot of smaller names coming out and reporting. A lot of the S&P 500 companies are behind us. There's only, I think, 13 of the S&P 500 reporting this week, and it has been an exceptionally strong earnings season. So an exceptionally strong third quarter earnings season. Right now, the blended growth rate for S&P 500 earnings is coming in at 13.1% year over year. And we've seen some really good beats on both the top line and the bottom line. And another reason why this is important is you want to pay attention to what these companies are saying about the present situation and the outlook is because while many investors and economists are all worked up because of the government shutdown, getting a lack of economic data, there is plenty of economic data being released right here. So look, this week you've got Home Depot, you've got Target, you've got Lowe's, we've got Nvidia, Walmart, and the list goes on. This is all you need to tune into these company reports to figure out what is going on with the economy and what these companies are seeing in their outlooks. One thing I want to keep an eye on this week is with New Holdings, ticker NU. This is a Brazilian fintech name, and we've seen under the hood a lot of stocks, especially on the growth side, pulling back. We've seen S&P 500 is trying to test its 50-day moving average again. So you really want to pay attention to stocks showing relative strength, and you can see ticker NU holding right at the prior high. So good relative strength in the stock is showing up in its relative strength line, the green line on here. What I want to watch for is we're coming up to this $16, $17 resistance level, originally approached or seen at the end of last year. If we can get, so we've tested it again back in October, late September, early October. We've had a smaller pullback. If we get just one more smaller pullback off that level, that's evidence of accumulation. Again, we're seeing that relative strength. And so those are all the right conditions to see a breakout. So keep an eye on this name this week. All right, that is all for this.